Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, October 4th, 5:03 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we've got an upgrade, still in a correction as we're still below the key moving averages on all the indexes, but day two of strength adds bear market rally onto the correction designation. If you can look over here, in the upper right on the trend gauge, we've also upgraded leadership from downtrend slash bearish to neutral with the green arrow pointing toward bullish. A lot of good action in the stocks that, and surprisingly, really not surprisingly, led by the stocks that held up the best as we had that recent leg up into the 200-day moving average, then the next leg down, which looked like it was going to be leg three. But now we've got that 2-day bounce now. But those are the stocks that held up the best, and those are the stocks that are coming back the best. For the most part, it's not all of them. But when you maintain your focus list, your watch list, your universe list, you always have a good idea of what's leading the pack. Meanwhile, the three indexes, they were stretched so far to the downside that they still haven't gotten off of bearish slash downtrend mode, as all five of the major indexes are trending below their short-term 21-day exponential moving average, the medium-term 50-day moving average, and the long-term 200-day moving average. However, what just happened today? Strong day two higher 21-day exponential moving average above. This is where the rubber's going to meet the road. It's the first challenge to the 2-day bullish rally. We'll see what happens when we get there. Very green on the day. I remarked yesterday that when we were putting check marks in the plus or minus column, that the leadership of small and mid caps was definitely something that gave us some conviction to be adding stocks on this, what some say is a day one. Others, including myself, could argue it's a day four for the leading indexes in this case, which are the mid caps and the small caps. So good stuff there. The G6 led the way. The G6 is our 6 growth ETF composite proxy for growth stocks. It's one of the ways we keep track of what's going on underneath the hood of the market. It was up 4.35% today. S&P up 3%. NASDAQ 100 up 3.1. Dow up 2.8. Mid caps and small caps led, up 3.9% each. Global diversified 60-40 stock and bond up 2.15%. We continue to add exposure. In-house today, our flagship GROTECTION portfolio up 0.87%. Again, very typical that during the first couple of days of an attempted rally, we're going to lag the indexes. This has happened multiple times. It's not something we're concerned about. We protected so much capital by getting out of the way of the sell-off that we have a major lead over the indexes, and we can afford to get out of the way as the markets are getting lower, and then take some steps back into the pond, so to speak, as we see rebounding and then confirmation of rebounding. And I'll go through the additional buys that we made today. We'll go through the tail of the tape and charts of interest. So let's get into exactly why we do what we do here at Revere. It's easy to just be a pie chart salesman. Somebody walks into a strip mall advisor. That was a great term coined by Tim. You know who those guys are. You tell them you got money to invest, they'll click a button, won't do any work. Something will pop up and say, well, this says you should have 45% in a large cap core mutual fund and blah, 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 until your money's all allocated, one shot, all in, regardless of the technical action or the risk or the health of the overall market. And then they do nothing while your account goes up or down, putting you at the mercy of the market. We don't do that here at Revere. We take a measured approach every day of the year, every year of the decade, every decade of the century. I could go on, but I won't. But look back here in October, last October, November. This is where we want to get to be. This is where the indexes are trending higher above their short-term 21-day moving average. That's the green line. Their medium-term 50-day moving average, that's the red line. The long-term 200-day moving average, that's the black line. When you're trending above there, we've got as much of our client portfolios allocated to the market as we're comfortable doing. And things aren't always rosy in the market. They don't go up all the time. Sometimes they consolidate, and there's normal consolidations. Sometimes there's abnormal pullbacks, and we've got signals for those. One of the chief signals is when they start to roll over leadership, our stops will start taking us out of the market, and the slopes of the short-term and intermediate-term moving averages will start to roll over. That tells us something's up. And then if you break the black line, the 200-day moving average, I say this every night, but you got to know it. Eventually, you'll be able to say it right along with me. This is where risk is at its maximum. Here are the last 13 bear markets reflecting the drawdown from the intraday high to low during the time period. And if you get hit with one of these close to retirement, you don't have time to recover, plain and simple, especially if it's one of the severe ones, severe being over 30%, the average of the 6 severe bear markets, down 44.5%. It takes you 80% to get back to even. You created and padded and feathered your nest egg your entire life. You're going to lose 45% of it because whatever you're doing with your money has no downside. People talk about FOMO, fear of missing out, to the upside. What about FOGL, fear of going lower with your balance? That's what we protect here at Revere. And I pretty much just went over the approach for why we get out of the way. Let's talk about getting back in, which is what we've done over the last 2 days. Our primary signal is we look for there are several signals. The earliest entry one is a failed undercut and reverse higher. A classic example of that is this area here. Let's go to July, where we made a lower low intraday. Things were looking horrible, but 714 we reversed and closed higher. That is a failed breakdown. Failed breakdowns are as reliable and low risk as you can get, because if we go lower than that, you've got to stop right below that level. So the odds are in your favor to take a shot no matter how bad things are looking. Then we'll take a look at the moving averages, the 8 and the 21, and if we start to get above there, we'll add, and we'll take pilot positions in leading stocks, and if they continue to work, we'll just add more. And that's what we've done the last couple of days. Here was your failed undercut on 9/30 last Friday, last day of the quarter. Overnight into Monday, you had a failed breakdown from there and a positive open. So there you have it. You've got your opportunity to get back in. We saw it. We added about 30% exposure yesterday, the equivalent of 30%, and another 30% today. On the gap up now, changing character, look at the purple line. We've been below the ADMA going all the way back to mid-September. It's now hooked back up. We got into it yesterday and stopped lower and gapped above it today. And now here's where, as I said, the rubber meets the road. We're coming into, it's now flattening out the declining 21-day exponential moving average. It rolled over here with this big move down on August 29th with Powell's Jackson Hole speech when he talked tough about continuing to raise rates to get inflation under control. The markets had two legs down since then. Included in here was bad CPI data, but now we're bouncing. We don't know how far the bounce is going to go, but we know we want to participate in it if it happens, just like we participated in this move off the low in July, which was thwarted into this downtrending 200-day moving average. So the first step to get across will be this 21-day exponential moving average. If we get above there, we'll add exposure. If we get above there and fail, that'll be a big signal to us that maybe we're not quite ready yet. And we may have to tap the brakes or at least stop adding exposure. A good example of this would be right here with this move off the low. We had a close above the 21. We went higher the next day, but closed below the 21, but it was just a fake out. And then the next day we went higher. So we'll go in slowly at first, and then as the gains start to come in, we'll start adding to it. So first thing that we're looking for, the big key tomorrow on the S&P 500, and frankly all the indexes, is what happens with this declining 21-day exponential moving average. And if you want a common sense approach like this, a couple of signals, we employ them. We take decisive action with low risk entries and tight stops to Risk management is our first job here. You manage your risk, control the downtrends, and the returns will take care of themselves when the bull market comes back. Plus, you have the added fact that you get to sleep well at night. I mean, does it get better than that? To me, it doesn't, and that's why Danny and I have all of our money in the same approach that that clients in GROTECTION have. It's just a common sense approach. And if you're interested, give me an email, don@revereasset.com or dan@revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. Let's go on to the rest of the indexes. NASDAQ 100 led on the way down, leads on the way up, leads on the way down. Not really leading. Yesterday it lagged, mainly because of Tesla. Tesla had a decent bounce today. But again, coming into this downtrending 21-day exponential moving average, we want to see what it has when it gets there. Dow Jones industrial average right at the 21. Same situation. We'll be monitoring that closely. Same with mid caps. Mid caps got above the 21 today. So there's your first indication that there might be more to this rally than just a couple of day bounce, and go back below and look at small caps also above it. So good news there as far as, we place most of the weight on the SPY and the Qs, but we certainly, when growth stocks are working on the small and mid cap, that's good stuff for us, because that's, especially mid caps, that's the pond that we fish in. Mid caps and large caps. We don't get so much into the small caps because they're just not liquid enough for a firm our size, but we're certainly happy when they're acting well, and we look for stocks to graduate into having enough liquidity for us to be able to participate. And the offset to this is investing in leveraged ETFs when the market is acting well, to get the bang for the buck that you get from these William O'Neill type growth stocks. I've also been paying a bunch of attention and talking about, this happened midweek last week, this hookup on the stochastics. No matter how bad the market looks, it doesn't go down consistently in a straight line. Now, we might just get a couple of day bounce like we saw here when we had the stochastic cross and it failed, or it could zigzag higher, or it could go straight higher. You never know what it's going to do, but right now we like the way this is acting. We like that small and mid caps got above their 21, and we'll see what happens when the large caps get there tomorrow. So there's the indexes. Now let's take a look at the G6. Led off by IWO. This is the growth component of the Russell 2000 above the 21 day. Good stuff there. The second one is FFTY. This is the IBD 50, sitting right below the 21. But again, these have been showing relative strength since the middle of last week. You'll note that on all the lines, and they've also got the stochastic line crossing higher. PDP is next. This is a Dorsey Wright Momentum ETF above the 21. QQQJ, this is the mid-cap NASDAQ 100 above the 21. ARK-K, Kathy took a beating yesterday because of Tesla. She bought a bunch of Tesla on that move down yesterday, above the 21, up 7.6% on the day, got quite a bit of that back. And then MDYG above the 21. Tesla was down yesterday because of they were light on their deliveries for the quarter, even though they were all-time high deliveries. So that was the reason for the move down. And the chart does not look like a leader yet, as it's had that gap down and then an inside-ish type day today, not making a lot of progress. But if it comes back, and we're looking at the large caps, Apple and Tesla, to see what's happening here. Apple off the bottom, first close above the 8 EMA. This was the leader on the way up. Look how it rode the 8 EMA higher. This was just a beautiful sight to see. But just the way it rode it up, it rode it back down again. And we'll see what happens with Apple over the next couple of days. This will probably dictate what happens with the S&P 500 and the NASDAQ 100. Okay, so we showed the G6, we showed the major indexes. Let's go to the tail of the tape now and see what's changed here. We've got the bear market rally in process with the correction. Technical, I've highlighted it to green now with the confirmed hookup of the indexes and the G6 daily stochastic out of oversold, pointing the way we want it to. Will they run for a while? We don't know, but we're going to keep an eye on it. Put call, 0.98, nothing to discuss there. VIX still high above that 24 to 26 band at 29.07. Above the moving averages. Fear and greed up to 30, so off of extreme fear into fear. Still operating under this bear case, but we do have market leadership, and we need to get above the 21 to get back to the bull case. So we went from 1 up day on the S&P to 2. Elon Musk finally relented to buying Twitter. He was trying to squeeze his way out of it because of fake accounts and so forth, but in a surprising move before the trial started, he said, all right, I'll just buy it. So filed the appropriate forms, and apparently he's relented and he'll be buying Twitter, and it gapped up on that news. So expectations coming into today were neutral. Yes, we've got the breakdown. Then we had the bear market rally starting yesterday. Big positive day, so this will change our expectation now from neutral to negative to neutral to positive, seeing what happens when the big cap indexes get into their 21-day exponential moving average. As far as the support and resistance level goes, we got above R1 on the S&P, gapped above it, came into the bottom. Our high today was 37.92, so this next R2 level, which is also where the 21-day exponential moving average is. A lot of key levels in here. It's a big resistance level. We got to see if we can get through it. Same thing on the NASDAQ, gapped above this support and resistance in this next big fib, which played a big role as support, this 286.80 level. We got to see what happens if we can overcome that. There's your action today. A gap up higher, 3-hour base, faded to 37.54, and then trend up into the close. I didn't talk about the news, somehow I glossed right over that, but one of the reasons for the overnight gap up, yesterday late, the UN asked the central banks, please stop raising rates, you're causing a global recession. Pretty funny. You'd think that they don't control the central banks, but then Australia said, well, maybe we hear you. They were supposed to raise their key lending rate by 50 basis points. They relented and only raised it 25. That kicked off another rally. Anytime you're going to see any indication of the Fed getting more dovish, any central bank for that matter getting more dovish, this has been leading to market rallies. Then JOLTS data, this is employment data, came in weak. Job openings weakened. This is again something that the Fed wants to see because the strong employment keeps wages high. High wages keep people spending high. People continuing to spend keeps inflation high. So part of cooling the economy is to take away some of the demand from the supply-demand equation. So more negative data, which actually leads to positive moves in the indexes. As far as sectors, 11 out of 11 were higher today. Oil's up big for the second straight day. OPEC now coming out and saying they might cut even more than they said they were going to. Retail strong, bank strong, transports, semiconductors, and cloud stocks. And again, the only negatives, same as yesterday, the US dollar and these managed futures ETFs that we've been tracking. Let's take a look at the US dollar here. This is important. Right now we're looking at a complete reversal from the breakout move right here around this 29.65 level. We've given it all back. It's our first close below the 21. But bear in mind, this can change at any time. This is having a big impact the last 2 days on what's going on with the market. And if the dollar gets strong again, the market is going to weaken unless that comparison that we've been seeing between the dollar and the market comes off. What we've been seeing is strong dollar, weak market, weak dollar, strong market. And see if that continues or see if that relationship breaks. We did have one close below the 21 here back on 9/12, but got right back above it. So here's a close above the 21 again. Let's see what happens there. Let's check out the VIX real quick. We did talk about that briefly. The VIX bounced at this 21-day exponential moving average. So it's below the 8, just like the S&P and the NASDAQ, but above the 21. I'm sorry, just the inverse of what's going on with the S&P and the NASDAQ. They got above the 8, but not quite below the 21. If this breaks the 21, and then you look to that 26 to 24 area, below 24 is bullish. Alex, our former employee and still consultant, has put a lot of study into this and watches it closely. And he keeps us appraised of his evaluation of the VIX. So focus coming into today was where are we going to continue to see relative strength in the leaders? And I went from shorting the indexes into the declining 21 to watching the indexes into the declining 21 when the mid caps and small caps got above the 21. So now we want to see what happens when the big boys get into that. So we continued to add today. We have 5% U Pro. I switched to SPXL. I have my reasons for doing that. To just keep the buys separate when we're tracking the profits on the accounts. So this is a 3 times S&P 500. We're not using SSO because we had a wash sale for taxable accounts. So we go back into that, you lose the deduction of the loss. So we switch to the 3-time ETFs for the time being. So we got a total of 12.5%. So that takes us to just under 40% with the gains that we've had, exposure to the S&P 500. I'm a big fan of the S&P 500, about how the rotation from value to growth and from sector to sector takes place beyond there. It absolutely smooths the portfolio returns because all of that rotation takes place within the S&P 500. So we just add the leverage to it to get the better return when it's bullish. We also added 3% in CF and 2.5% to First Solar. So let's go through now what we own. You already know what the S&P 500 looks like. So the 3 times ETFs aren't so critical there. We've got one that's stock that's lagging, lithium. It had to shake out yesterday with the downgrade, got above the 21 but didn't hold the 21. But this is still in good shape, so that's our first holding. Second holding, CEG. This was the first buy yesterday. Alternative energy acting very well. There's several stocks in this group that are acting well. 2 nice days up on CEG. Our third buy was First Solar, and we added to that today. So First Solar, this is the canary in the growth stock liquid coal mine. If the rally's going to work, First Solar's going to work. If First Solar fails, I wouldn't be surprised if the rally fails. Clean break out of this 3.5 week base. Very clear. 140 was the pivot. Broke above it. Any pullbacks were held by 140. Let's go to a 5-minute chart on this. So there's the gap above 140. Came back a couple times, but no lower than 141-ish. It did fade a little bit. But a little bit of strength into the close. It was one of the leaders that held up. Look at this, only one close below the 21, and we talked about it constantly about we weren't in it, but it was leading, riding this 80 MA higher. So now put in this nice 3.5, not quite a 3 weeks tight, a little bit of volatility in there while the market was pulling back, but held up extremely well relative to what's going on. We know we've got the Inflation Reduction Act that is throwing a bunch of money into green energy. First Solar definitely taking advantage of that, and look at that relative strength line. Gotta love that. And then finally, CF. Michael talked about this in one of his segments on the podcast about how this and NTR were the leaders. Failed breakout here, pullback, bounced at the 200. That's the final line in the sand for when fund managers want to step into a stock that they want to own. Now, note how we made a lower low here in the S&P, did not make a lower low on CF. So the relative strength took over. It's made a higher high now on RS, even though it hasn't relative to price. So it's showing relative strength. Above the 21 yesterday, above the 50 today. Good volume both days. In fact, for the last 6 days, the volume has been higher. The 2 down days have been on lower volume, and they were really consolidation days after this nice bounce off of the 200-day moving average. Michael talked a lot about how you absolutely need these fertilizers because of the food shortages that are going on with the war in Ukraine, etc. And this really has the potential to lead. We got a good entry on it, and we'll look to pyramid if strength continues. So those are the 4 stocks that we own: CEG, FSLR, LTHM, and CF, and then the total 12.5%, 3 times of the S&P 500, and that equates to an adjusted beta of basically a 60-40, 60% S&P, 40% cash portfolio, a little bit more than that. But we've got a lot of dry powder still to add into leaders and to these ETFs if the market continues higher, particularly if the big cap indexes get above the 21 with some gusto or go sideways for a day or two and then break above. That's really our preferred scenario, but you don't always get what you want, as the Rolling Stones have taught us all. So bottom line, second strong day off the low, declining 21 overhead on the NASDAQ 100 and SPX. What happens when we get there will be critical to the overall rally. That's what we're watching. This really big resistance area we're coming into, 3,800 to 3,815, 21-day moving average, the 20% year-to-date level of 38.2% fib. If you clear 3,815, we've got a pretty big run all the way up near 3,900. So that is the bull case. The bear case is we roll over when we get into the 21 and can't get above it, but we don't predict. We'll watch what happens. We'll react accordingly. We know we can outperform when we get our money into the leaders, and we know we can outperform when we have what we call crisis alpha, meaning the indexes are going down. We recognize when there's risk, we get out of the way, and we wait until the smoke clears to get back in. That's going to wrap it. As always, love to hear from you. Don at revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the markets, it's how much you keep. Just the facts here at Revere, no opinions. So wrapping up Tuesday, October 4th, this is Don Vandenbord telling it like it is. Thanks for listening and have a great day.